Now, with the stock market hitting all-time highs, it is making many wonder if there's a major correction coming. And then there's the Fed and interest rates. Here's wealth manager Emily Hill on CNBC.
The Fed has become very adept at signaling what they're going to do. They've said they're going to cut rates once, and I expect that they will. Inflation data, I think, by the end of the summer especially, is going to continue to surprise positively. And so I think we are actually set up for a very good situation for markets. It's going to enable one, potentially two, but most likely one rate cut in the fall. And I would say overall, the bull market as a result is going to be intact. And I think Chairman Powell has pulled off a soft landing.
It's definitely what they were hoping for from the onset. But is it too early to ring the victory bell? Is it time for protection, or do you see maybe riding things out a little longer?
I think if there's one thing that we've learned ever since inflation became a real problem in 2021, 2022, is that we really have no idea what inflation is going to do. It's been extremely difficult to predict inflation, and then what really matters for the markets is what interest rates are going to do as a result. So if you take a look at, interest rate predictions from all the big investment banks at the start of this year, at the start of 2023, they missed it by a long shot. We thought inflation was going to be coming back down much faster than it has, and it's really gotten a little bit sticky around the 3% area. And if we know that the Fed's goal is about 2% from this year compared to last year, it's not even concerned with the fact that compared to 2019, and prices are 30 or 40% higher. But as far as are we due for a market correction, I think that we're definitely due for a market correction. We've seen some pretty, lights out performance from the S&P 500, which is what we consider to be our market, proxy. But yeah, we've had some really great performance so far this year. When I was looking, as of this recording, it was up 17% year to date, and that's not even including the 2023 awesome performance. But so that looks great, but what's really caught my attention is the really narrowness part of this rally. And what I mean by that is only 7 companies within the index of 500, they've contributed over half of the gains.
Wow.
So, I don't know what the fraction is, 7 divided by 500, but it's a lot less than 50%. So really what this means is the market's really being held up by such a small amount of the companies within the index, which is not what you want to see for the market to keep going up. This is actually, there's another data point I'll throw at you, and this is the last one. But going back to 1973, which is when data became available for this stat, only 25% of stocks this year within the S&P 500 index are actually beating the index. So you think of the S&P 500 as the average stock, it's up 17% year to date. Only 25% of the stocks in that index are actually beating the index. So that just means only a couple of the stocks, like I said earlier, they're really beating the index. So, you think about the Magnificent Seven, if you've heard that on TV, on CNBC, you've got NVIDIA, Apple, Microsoft, Amazon, Meta, and maybe I'm missing one or two, but it's really just those stocks driving this growth. So what's to happen if NVIDIA has a really bad quarter? It's gone up over 100% year to date. And that's not including 2023 and from the bottom of 2022. So when you start considering how narrow this rally is, coming back to my point, I think we're really vulnerable here, I would say.
Sure.
So it's like a skyscraper built on no foundation, really, is what you could compare it to. So, I do think we're due for a correction. I don't know how big this correction is going to be. If the rest of the index actually picks up the performance, then we're fine, but that's a big risk. So some way that we prepare for this is, first of all, we equal weight our portfolios, our stock portfolios. So that's compared to the S&P 500, which weights it based on the company's size or the market cap. So if you look at only the top 3 companies' weightings in the S&P 500, those total 20%. Whereas if it would be equal weighted, it would be less than 1%. So they obviously have a really big sway. So if we equal weight it, where we don't let Apple and Microsoft and Amazon and all those stocks take up the entire weighting of our models, we really reduce the risk from those types of companies.
Well, when I look at that, the thing that scares me about that is those 7, the Magnificent Seven or whatever you refer to it as.
There's a new name every week.
There's a new name every week. So they pretty much are controlling I mean, if they decided we need to kind of back things down a little bit here, you're going to see a major correction, right? I mean, am I wrong in that? I don't know how all of this works, but when I see that 7 companies are driving most of these gains, that scares the heck out of me.
Yeah, you're absolutely right. And the thing about these 7 companies, well, they are fantastic companies. We own them, most of them, in our models. You know, they have a good amount of cash, low relative debt, and high returns. They're great companies. It's just the fact that they've gone up so much in such a short amount of time, and they're based on expectations is our biggest worry. They're based on expectations of AI, artificial intelligence, generating a huge return on their investment.
Sure.
Whether that happens or not, or maybe let's say there's a recession, which some indicators are pointing to, all of those expectations could get dialed back quite a bit. The stocks would go with it, and so would the indexes.
You know, I know I've heard, you know, on CNBC and different outlets that they were talking about 2 or 3 rate cuts. I haven't seen any of that yet, and they've been talking about that for the last year and a half, and I just don't see where that's on the docket right now.
Yeah, one of the biggest things that the Fed focuses on, the Federal Reserve, is the jobs numbers. So how many jobs did the U.S. economy add over the last month? It's one of the biggest economic data releases every month. And then how that affects inflation.
Sure.
And all that we've found out, like I said at the beginning of this, is we have no real good way of predicting that. If you look at, I'm getting my years mixed up now. I think it was the start of this year. It was everyone was expecting there to be 6 rate cuts.
Yes. Yes.
Over the course of 2024. We've dialed that back to maybe 1, maybe 2. So really, you can tell that the market has no idea how to react to this information.
No, it's AI for you, right?
It's AI. Whenever you question why the market's up or down today, it's an AI play. Is Nvidia up 4% or is Nvidia down 4%?
Well, that's great information, Connor. I'm sure the listeners will take heed to everything you're saying here, because it is really, really good information. And like you said, we really have no idea. We never know. But being prepared for something is always, the Boy Scout motto is to be prepared. And you definitely don't want to react to it. If you can put some circuit breakers in place and have some things put in place to kind of help if the market does have a major correction, which God forbid it does, but if it does, if you're prepared for that, it's not going to necessarily blow up your portfolio.
A large part of being prepared is, being able to control what you can control. We can't control when the Fed is going to cut rates. We can't control how the market is going to react to those rate cuts or lack thereof. What we can control is how our portfolios, how our plans are set up to react to that. Being able to take advantage of the interest rates as they are, as elevated as they are right now. Obviously not the best time to go out and refinance your house or get a new car loan or things like that. But there are strategies, there are vehicles that you can use to take advantage of those rates. And then, if the market does take a downturn, inevitably it will, being positioned in a way where you can use that as an opportunity to buy in, low, as the adage goes, buy low and sell high. But having a little bit of that discipline on your side, sometimes it's easier said than done, but the team at America's Retirement Headquarters can help you with that and know when to pivot and know, when those opportunities lie. All you have to do to reach out and start that conversation with them, figure it out, is 419-794-3030. That's the number. Or you can go to the website as well, schedule a time there, arhq.com.